I'm Courtney Kidwell. I can speak. Stearns Financial. I am in the Greensboro office, and I love being in Chapel Hill. I'm a Carolina grad, so any excuse I can get to come back over here, I'm all over it. I'm joined tonight by Shira Katsir and Dax Dixon, along with several members of our team. We've got Lisa Gibson, Joyce Black-Staley, Patty Steinke, sorry, Teresa Talton, and then we've got Bill behind the camera back there. So you may see some of these names via email or in other chats, so here's a good time to put a face with a name. We are going to try to stay on schedule tonight and move along. You all have a handout in your seat. We'll have the slideshow on the screen. You'll notice that it is different than what is in your seat. The good meaty details of what we're talking about is in your handout. So if what we're saying you want to know more, you can look on the handout or ask us. But just understand that what's on the screen is different than what you're looking at. I'm going to let Dax start off. And, we're going to click along here. We're going to start with questions and issues. As we go along, if you have a burning question, please raise your hand. We're going to leave time at the end of the evening for a Q&A and then some conversation one-on-one. So if it's something you don't feel like you want to hear everybody ask, then feel free to wait till the end. But if it's something you think relevant, then go for it. Raise your hand. All right? Any questions? All right, I'm going to give it to Dax.
So my name's Dax Dixon. Know most of you, but I'm the portfolio manager in Chapel Hill for most of Holly's clients. We actually made this presentation, got it through a compliance last week. So there's one big issue that's not on here. And we won't be addressing because we haven't, no, I'm kidding. So these are some of the key questions and issues. I guess you could slot that one under wild cards. And honestly, we as an investment committee, we're not going to deal with any of these in isolation, right? So when you think about inflation and Fed policy, that's very much tied to other things within here, whether that's China reopening, what's going on in the U.S. economy, or within corporate earnings. I think the big wild card right now is what's happened in the banking system over the past week or so. Has anybody heard about this? Is this new information for most people? Late last week, the Silicon Valley Bank had some issues, to put it mildly, and what happened, just kind of high level, what happened within the bank, is that they're very much tied to the venture capital markets out in Silicon Valley. And so because of easy policy, money policy in 2020 and 2021, a lot of money entered into the ecosystem, and a lot of that entered into the venture capital space. And so this bank, what they did was they purchased a lot of long-dated treasuries on their balance sheet. And so last year, Federal Reserve policy tied to inflation, because we had high inflation, interest rates went up quite a bit. It was a historical year for interest rate policy in the U.S. Never have rates been that high or gone that high in 1 year. So you went from almost 0 to a little over 4%. So what happened, all the bonds on that bank's balance sheet all of a sudden declined in value. This meant their Tier 1 capital requirements weren't what they needed to be. This meant that the Federal Reserve and the FDIC had to step in. This caused a run on the bank, so on and so forth. Over the weekend, the Fed and the FDIC and the Treasury, they're going to step in and make that process a little bit more orderly. We saw a huge sell-off in regional banks yesterday, but we saw a reversal of that today. So right now, Stearns is not of the opinion that that's going to be a systemic issue, but it's certainly one of the wild cards that we didn't have listed entering the year on anybody's radars. And I think, inflation is very much, the Fed so far has been, we're going to continue raising rates until we get inflation under control. However, I do think this episode may slow them down a bit because it may cause some disruptions within banks because of the capital requirements on that. Susan, do you have a question?
When you said a sell-off on regional
Yeah.
today. I didn't listen to the news this evening. What does that mean?
Okay, I'm sorry for my investment speak. Basically, there was a number of regional banks yesterday that were down 15, 20, 30%. There were several banks where trading was halted because they hit certain stops within the system. And so basically it's like there's one bad actor and that whole sector was negatively impacted by that. I mean, Schwab, a very solid financial institution, was actually down at one point 20% yesterday, and today it was up about 13. So you can see how much sentiment can drive kind of action on an individual company at a given point. So other than that, there's not much going on in the economy at this point. Just kidding. So China is reopening, which, when you think about China reopening, outside of the Taiwan question, that creates a lot of cross currents within the economy. So on one side, they produce goods, which may be disinflationary, but on the other side, they're a big user of raw inputs, which may cause the cost of commodities to inflate. And so you're going to get kind of which of those effects is going to dominate is still to be seen. I do think over this year, and I think the investment committee would say that we do expect inflation to trend down over the year, but it's not going to be linear. And what happened last week within the banking sector may cause the Fed to slow down, which may mean inflation continues for a little bit longer. But I'm going to go ahead and turn it over now back to Courtney, unless there's any questions before I do so. Okay, Tom.
Just a really quick question about the bank thing again. They said that deposits at that California bank were going to be made whole.
Yep.
Where does that money come from?
I think that's a good question. I think basically, high level, the Fed and the Treasury are going to create a facility where they're going to buy those assets. I mean, they're going to buy the assets from the bank at par that are underwater to create that and make it more orderly than what it would be otherwise. I think it's shades of different. There's a lot of difference between what's going on with these banks or with this bank and what happened in 2008, because it's mostly a bank for corporations, right? And so you're talking about small businesses, venture capital businesses with people, they have to make payroll, right? And so I think it's one of those things where it's probably needed at this point to provide some stability in the system. And those two institutions are going to help make that sell-off or wind down a little more orderly than some of the chaos that would have ensued otherwise. Any other questions? Mike?
So is that going to be both the insured and the uninsured?
Yes. Yeah, so 90% of, I think it's 90%, it might be 85, but most deposits are above the FDIC limit because most deposits are in absolute terms, are going to be by corporations. You can't, as a business, you can't spread it across 10 or 11 institutions and still be able to make payroll and things like that. So, anyway.
Thank you. Anything else? Well, I think just like the banks, we've got wild cards. So we have on here protection against wild cards. You didn't see the bank coming. We probably didn't see Putin invading Ukraine last year. So those are the kinds of things that we talk about that you just don't know if they're coming, but what do you do to protect yourself? We've got, some people may be familiar with CORE and EXPLORE. Anybody have that discussion in their investment? So we talk about a lot of times, especially as you're moving into retirement, you have your portfolio and you know an amount that you need that needs to stay stable, needs to stay growing at the right amount, not too much risk, that you know that your bills are going to get paid, you're going to have enough growth to keep up with inflation, you're going to have money to pay for your medical expenses. But you might have a little extra over there that you're curious about, and I don't want to say too many things, about Bitcoin, let's say. I'm not sure anybody in this room wants to do that, but that would be something that we would not necessarily say is a core holding. So you have an area that's more an explore, where you can maybe take on a little bit more risk. It might be something in genomics. It might be something more small caps, just something that is not in your normal core portfolio that allows you to dabble and maybe get a little more return, but you know at the end of the day, whatever happens to that explore portfolio, that you've got your needs met with the core. So that's a strategy that you can use, that the wild card situations would affect your explore more, but you know you've got your core. So that is one strategy. At the later stage, if you have a stock position, say that you were an employee of Coke way back when and have Coke stock and have always had Coke stock, and you have reinvested the dividends and you have even more Coke stock now. Well, that position is probably, not in an ideal diversified portfolio allocation right now. So as you get older and that becomes a bigger holding, that's something to make sure you have a strategy around. At a certain point, right now with capital gains rules the way they are, a lot of times people get to a point where they're just like, you know what, I'm never going to sell it. I will hold it when I die, and then it's going to go to my kids, and then they'll be able to sell it without having to pay all the capital gains taxes. So this is where you start to think about whether you need a wind down strategy, because there are some tax efficient ways of getting rid of highly concentrated positions like this, but that's a good conversation to have if you happen to have one or a few particular stocks overweighted. Let me just hold this so I don't have to keep going back and forth. Impact from the semiconductor and supply chain interruptions. A lot of the supply chain issues came about with COVID. I'm sure we all took longer to get packages and pieces, and wasn't it Ford trucks that were missing a semiconductor piece? So a lot of that has wound down. There's still some hiccups in the system as things have evolved and changed, but that's something that we're still kind of dealing with in different sectors. Diversification beyond bonds, farmland and toll roads are not impacted by Russia and China. I don't know if anybody has heard Dennis's spiel about pistachio farms, but we have a lot of alternatives. One that most of you, if you're a client, have in a portfolio called Versus Real Assets. And Versus has farmland, timber, infrastructure, things like water treatment plants, ports, different things that are creating income, having some growth on them, but creating some stability in your portfolio. So when bonds were doing miserably, I think last year was their worst year ever, things like real assets were a place where we could put funds that gave you some of that stability, gave you some income, and got you away from what was happening on Wall Street. Because the pistachios continue to grow, that people keep driving down the streets, and I just got a bill from a trip to Florida for my toll road. So, it keeps coming. Then we've got working capital accounts. I don't know if anybody was at our session, I believe in January, that we talked about working capital. We see a lot of benefit when it gets scary, because we're experiencing volatility that people just they don't know if they're going to have the money to pay bills. If you're working, that's one thing. You've got a paycheck coming in. But once you're not working regularly anymore and you're taking that income stream out of your retirement portfolio, what happens if the market has a really bad day and you're forced to sell something that's at a much lower value than it was just last week? So we're looking ahead at how long and how much money you may want to go ahead and free up when you have the opportunity. And you can put that in a separate working capital account. Our working capital accounts are not billed, they're not managed. We are doing things like cash management with some treasuries, some bonds. Right now, money market is paying more than 4%, which is unheard of recently. I mean, it's been zero for as long as I can remember. So working capital is a place where you can carve out, and we talked about further down here how much money you take out. You might you might be very nervous, and you want to say, okay, I know I'm going to need $100,000 to get me through the next 2 years, and I want that in cash, and I want to know it is there no matter what happens. That's the prime time that you can say, okay, I want to get some money freed up, putting it in a separate account so that when Shira and Dax are doing the portfolio management and they see cash sitting in a portfolio, they don't invest it. So we separate it out of sight, out of mind. You know it's there. You know you can pay your bills. So as the market goes up and down, and we have the volatility and we have randomness happening, you know that your needs are going to be met. So that's the working capital. That is talking about how much money you're comfortable with having out there. Creating an income source. When you're working, you know, you've got the income. When you're not, these days, how many people have a side hustle? You know, in different ages and stages. I know that some people think the internet is the best thing to ever happen, and it has opened up the world dramatically so that you have access to all kinds of people and places and experiences all over the world, but it's also very limiting. So some people are scared to get on the internet because everything you do is out there on the internet somewhere. Some of the movies I've watched talk about somebody like breaking into the Echo Dot. You know, so it's scary. I'm out there as well. But anyways, there are ways to create income. I have a client that does some pottery. She has an account on Etsy. She sells her pottery on Etsy. There's all kinds of products and different things that you can sell, income sources. I'm not saying you need to go out and be a Walmart greeter. Our intention here is to set you up that you can do what you want, but some people still want that, the stimulation, the social stimulation and being out and about. So it might be something that can create income. When we get into the financial planning later, we'll talk a little bit more about part-time work. And then sometimes spending some of your net worth just to have protection, there's insurance. If you're worried about depleting your assets and leaving your loved ones behind, whether it's a spouse or kids, whoever you're worried about, the money that you've saved, the money that you've earned is your money. And I know when I'm talking to clients, I want to make sure that their needs are met. So hopefully you're not worrying about the next generation or somebody else. So there are plenty of things that you can do that can set you up. All of this is in your retirement, in the age when you're converting from save to drawing down. And it is an absolute mind shift that you have to go into the withdrawal mode. Your balances are no longer growing as much. Hopefully they're still growing, because hopefully you're not taking out too much. But it's a very big mind shift. Shira is going to go through next and do a life aspiration exercise, because we find a lot of people just think, oh, it's at 65, I'm going to retire, and then you wake up and retire. You kind of need to do a little more planning. That's why we're here tonight. We're talking about retiring like a champ and some of the things you need to do to be successful. So we're going to try to get a little interactive here.
Thank you.
And then we'll move on. Oh, got it.
Thank you. Thank you so much. Yes, so this is the part of the exercise or of the evening. So strange to say that when it's still daylight outside, still adjusting. So we've been talking a lot about external things going on in the world. Now we're going to shift inward. So in front of you, you have a pad of paper and a pen. So I invite you to use that as we go through this exercise. Now, just to set the stage, you don't have to do this. This is really between you and the notepad. No advisor is going to ask for this. You don't have to turn it in. It's all about getting to your life aspirations. There are different exercises we're going to run through. There's only 5 of them. And ultimately, at the end of the day, what we hope we're going to achieve is to have a list of what we think our life aspirations are, because it can be very challenging to just write down on a piece of paper what we think they are. Make sense? Everybody on board? There's no wrong answers. This is just for fun. Okay, so the first thing I'd like you to do is on your Stearns pad of paper, go ahead and write down at the very top, wish list. And I've done it here so you could see what it looks like. All right. And it's just what it says. So right now I want you to have a little fun. Somebody comes up to you and can grant every wish imaginable. What would be on that list? You want to play in the NBA. You want to travel to Spain. You want to be a nudist. Whatever it is. This is your moment. The wilder, the better. Everything you can imagine, now, retirement, beyond. You have. Because I've been talking and I've been seeing you write, so you've got 2 minutes. Come on, Lisa. You have to write your list too. Let's go. Any questions? Feel free to raise your hand. If you have writer's block, I can help you out. So my wish list has things like, I want to have 10 horses, 3 goats, 2 cows at some point in my life, have a farm. I want to run a marathon. I want to connect with my 3rd cousins that live all over the world. I want to learn a new language. I want to be a chef, open a restaurant, have a cat. Okay, you've got 1 minute. If you're done, you can put down your pen. I'll know that you're finished and we can move on. I want to write a best-selling book, become a world-class skier, produce a movie. Met with a client last week. He's producing his 3rd movie. All right. Wrapping up. All right, everybody have a wish list they love, are proud of, want to share with their friends and family? No, this is just for you. Okay. So the next step, and this is a fresh piece of paper, so go ahead and tear that wish list off, put it to the side, we're going to need it later. And I want you to do something fun, maybe a little challenging. I don't know all of you, but it requires a little bit of digging deeper, okay? So digging into our wish list. So on this new piece of paper, on the very tippy top, I want you to write life aspirations. And what we're going to do, and try to do, is take a look at your wish list and ask yourselves, why do I want to do this? What desire will it satisfy? And then on your aspirations, write to be and what that desire is. So for example, if you wrote something like, I want to take my kids to Disney World. Your to-be statement would be to be a fantastic and fun parent. If you said, I want to travel the world, your to-be statement would be to be an adventurer. So for every wish on this new piece of paper, really think it through. Why is that your wish? What's the reason behind it? Look at your wish list for every wish. Start your blank sheet of paper for your life aspirations to be, and take it from there. If I wanted my horse farm, if I really thought about it, to be responsible for life, to be accountable to creating it, to be independent. Think about what it is that really speaks to you, about the things that you wish for. Those are your aspirations. All right. Any questions about, okay, so Timer's on. 1 more minute. Thirty seconds. All right, we're getting ready to come out of our aspirations list. And for this next exercise, again, your life aspirations sheet that you're currently working on is the key to this exercise, right? This is what we're trying to work towards. And this next step in the process might help you. It's not an easy process. It might not come to you, and that's okay. It's just like when you go to the gym. You're not there to win the gym, right? You're there to work the muscle, and that's what this exercise is. It's just going through the motion of thinking through what we want now, what we want in retirement, and just what we want from our lives in general. So, no wrong answers. This next one might help you. I want you to think about all the people you love, your friends, your family, your coworkers, in a room celebrating your life. If you were a fly on the wall and you were listening to what they were saying about you, the life you led, the work you did, the person you were, what do you hope they would say? Go ahead and write down some of the things that come to mind about what you hear them utter that would make you proud. So what would they say? That you were fun, funny, mean, generous? Would there be nobody there? What do you imagine? Everyone standing around your grandkids, your children, your best friend? So just think about the stories they would tell about you and the life you led. You have 2 minutes.
Those are kind of different questions. They want to be remembered versus what they're actually going to say.
That's a good point. This is all about you. So that's a great point. And there's no wrong answers, but this is all about what you hope to hear about your life. Sure, exactly. That Shira was a great public speaker. She wowed the crowd, right? "30 seconds. What your husband said about you, what your wife is thinking about you, how much, the effort that you gave came out in the end. Did it matter? All right, I think we're all happy with where we are. So this next step is taking into consideration what your friends said, which can also help you fill in that life aspirations list. So pull up that life aspirations list, go back to it, and if it's not already listed, because it may already be here, think about the notes that you took from your memorial of what people said or what you hoped they'd say about you, and add it as a to-be statement. For example, I really hope that Dax and Courtney say about me that I helped them in their career and that I was so supportive at work and I was a great teammate and ultimately helped them get to where they wanted to go at Stearns. So my to-be statement on my life aspirations would be something like, to be a great mentor to my colleagues. Make sense? So try to connect what you want people to have said about you, what you hope they said, into a to-be statement. And there may be duplicates, and that's okay. That just means you're in alignment. So if you hope your kids said that you had unconditional time with them, your to-be statement would be to be the type of parent who never put limits on how much time I spent with my kids. I was always there. You have 2 minutes. Add to your to-be statements with all the things you hope to synthesize from what you heard. All right, I think a lot of us are writing, and that's great. And you can keep writing, because this next step, we're at the end, we're at the home stretch, we've done the hard work, we've really honed in our life aspirations, where we want to be, what we want to be doing. And again, this is just a starting block. This is just the first year of doing this process. If you've never done it before, the purpose of this is purpose. That's essentially it, and we're going to get to it near the end. But the idea of making sure that our actions are in alignment with who we want to be in retirement or right now. And going through this process and refining and looking through and figuring out if the actions we're taking are in alignment with what we want for our future is pivotal in having a successful retirement and a successful life. So keep this list with you, edit it down. If something doesn't resonate, scratch it off. There's no rules here. Nobody's looking. This is your list and yours alone. So I hope you guys had fun. I hope it helped you sort through things in your head. And I'll turn it over to Courtney. Keep going in front of that. Thank you. Okay, so I hope everybody has like this grand plan of travels or grandkids or something fantastic. What's the one thing you're going to need to pretty much make any of this happen? Money, yeah. So, sorry, circling back to Stearns Financial. Let me flip through. Here comes the fun part, the financial planning. Many of you are probably familiar with the financial planning roadmap, which is the big living, breathing document, I couldn't say document, it can be very thick, where we look at your income, we look at your expenses, we look at your dreams, we look at what you want to do, and try to help you find the strategy and the path to get there and have the finances to do it. A lot of things, like Dax was talking about, that is top of mind right now is inflation. How is that going to affect the portfolio that we have? What if inflation is higher for longer? That's something people are talking about. What if investment returns are more volatile or stayed lower longer as well? How does that affect what you want to do with your planning? Impact on you as we look at Stearns Financial clients in general. We hear all these big numbers for inflation on CNBC in the news. We find that a lot of our clients, their actual inflation to how it affects them is a little bit lower than the number you hear out there. Inflation includes shelter and, what is the other one? Sorry. Energy? No. Shelter. Food and shelter are a big piece of it. By the time you are retiring,
you probably have paid off your house, or you have downsized and managed that. So the rising interest rates for mortgage are not necessarily part of your outgoing expenses. One of the ways that we find that people can contain it is by choices that they make as they are planning to go out to dinner. Are you going out and having a 5-course meal with a fine bottle of wine, or are you going somewhere where you're going to have, a hamburger and a beer? There's different choices you make. So as we find that we call them guardrails, that when the economy is not doing as well and the portfolio down, you make choices that help elongate your plan. So if you see that your account value is down, you're probably not going to go book the Ritz for a 10-week or 10-day vacation in Hawaii. So you can still go to Hawaii, you just might not stay at the Ritz. So when we do financial plans, we look at the things like what you want to do and try to help you give an educated decision about what you should spend. So while inflation might be up, and I go to the grocery store too, and I see just a couple bags in the back of my car and it's $100. It's kind of crazy. What is it, eggs that have been crazy? I went to Costco one day and there were no eggs. Apparently they come in on Wednesday, they're gone by the weekend. So it's a different mindset. That's part of the supply chain, I guess. Now it's semiconductor chips and now chickens. So there's different choices that you can make, and I'm going to show you. In your seat, you also have an actual financial plan. It is a sample financial plan. In that, we give you 6 different assumptions. So we're going to show you what it looks like if in 2023 and 24, the portfolios go down by 10%. That's one scenario. The second one is where inflation stays up for longer. Just inflation stays up for longer. The third one combines those two. All right, so inflation stays up, the market stays down, and you've got both of those happening at the same time. These are the things that are not in your control. So we will show you what it happens to someone's portfolio when these 3 happen. The last 3 both have the bear market and inflation, but it's got what we call levers that you can choose to employ to try to help the trajectory of your portfolio. So one is downsize home. We know a lot of people, when it comes to retirement time, you start thinking, do I need this big house? The kids are gone. They come back at Christmas. Do I need to have this entire house for them all year long? A lot of people find it's nice to put the kids up in a hotel when they come home for Christmas. I know my mother would never do that, and that's her, and that might be your decision. She wants us in our rooms with the bedding that's still there from when I was there in high school, and she wants my boys to play with my sister and I's dolls. So, I get that's not for everybody, but that's the whole point, is it's one size fits one, and it's the choice that you have, and you can choose what you want to do with it. The second one, you've still got the bear market and inflation, but you can work part-time. So maybe you are a doctor and you're tired of going in every single day. I'm learning from working with doctors you can scale back in your hours. Maybe you go part-time or quarter-time, work once a week. So there's a need out there. I think one thing we didn't talk about a lot was employment. There are need for skilled people out there. So as you get older, you may not want to still be going full-time, full blast, but there's opportunities to use your skills somewhere that could bring in some income. The last one is, again, the bear market and inflation, but we both downsize the home and work part-time. Oh, Bill. We knew this would happen. Here we go. Hold on. Okay, we're good.
Actors out of your control.
Sorry.
Wild card.
If anybody, I am the technology mess up, challenged in our firm. Yes. Okay. So if you see here, this top line is your base case. So the base case is when we do a financial plan, we look at the here and now, the snapshot of what your money is doing. We use some assumptions for what the stock market does. So we assume over the life of your plan to age 100, we get 7%. So base case is showing an investment return of 7%. We can't show 7 1 year, 5 1 year, 10 1 year, 2 1 year. So that's part of the process that you know it's going to fluctuate, and we know that's when you have filet when it's up and you have hot dogs when it's down. Okay? Those are your own personal guardrails. The second one you can see right under it is what happens if inflation stays high. There's not that big a change there. 8% inflation doesn't bring your portfolio down that much. So while it might be a hot topic on social media and TV, and it is, and we feel it, I feel it at the grocery store and whatnot as well. When I get my energy bill, I know every time the kids turn on the gas fireplace, I feel like it's dollars going right up the chimney. So I get that. But if you look, at the end of the day, it doesn't make that big a difference, okay? What does make a difference is a bear market and a bear market with inflation. So you can see how your expenses are going to start to be more than your income, and you're going to deplete your money earlier. So those are things that are outside of your control, and it may feel dire if you've got these last two, but that's where you have the levers that can change the trajectory of it. So we've talked about your base case now is orange at the top. The blue right under it is if you downsize and do part-time. Part-time on this, it was a couple, both working for 5 more years, earning $25,000 each. So it's not a drastic income that you need to reproduce there. It may be one of you working a little bit more. It's not that long, but it really maintains your portfolio no matter what's doing in the market. Okay? Just downsizing your home, which is something you might be planning to do anyways, gives you a bucket of money that was tied up in equity in the house that is then invested in the market that's going to help buoy your portfolio. Just working part-time doesn't move the needle that much. And then you still see that you run out of money before the end if it's bear market inflation and you do nothing about it. So what we're trying to show you here is that it's the choices you make. So just like Shira was talking about what you want to do in your life, you've got to think about it. You think about what's important to you. So you react to what the market's doing. You react to what your portfolio balances are doing. That's why you have something like Core and Explore. You have something to keep that you know that you're safe with, to keep that value up there. You have your play money if you want to, but make sure that your needs are met. You've got the Core, and be prepared, even if you don't have to do it. Say inflation does go longer, say the market's more volatile than you're comfortable with. It's about you sleeping at night. Because one person might think, wee, this is I can buy cheap now that it's down and it'll get higher. That might make somebody just completely flip around in bed all night long. So whatever speaks to you, doing a plan, having thoughtful consideration, just like Shira talked about with what you want to do with retirement, think about the levers that you could look at. Is it downsizing? Is it not getting a new car as often? Is it not taking as many vacations, or is it just taking a not as nice hotel? Think about the sort of things that you can change, the levers that you can pull to help make your reality as close to that orange line up there at the top. Because hopefully 7% will happen, and hopefully you'll get to do all of the things on your list. Are there any questions? That was really quick. Okay? The financial plan that I'm talking about is in there if you don't know what I'm talking about a roadmap and a base case and assumptions. So all of that is in there for you to look at, and I'm happy to answer questions later. Dax is going to dive into investments more, the fun stuff.
All right, well, now is my time to shine. Before I do so, though, I owe you all a huge disclaimer. Someone probably mentioned a individual company earlier. That was in no way an endorsement of said company. Courtney also did so. These were for illustrative purposes only. Imagine I'm reading off my email disclaimer to you right now, and you'll get it. So about a week ago, I was actually in a meeting with Mr. Mike Pike back there. Hey, Mike. And I told him I was starting my career as a semi-amateur comedian, because I actually had a stand-up last week. And he was hoping that I would do some of my material here. Unfortunately, I haven't found anything funny about private market investment at this point. But I do find it interesting nonetheless. And so I think the history of private market investing, I think a lot of people think it's very esoteric, happens behind the curtain, so on and so forth. But if you think back about 5 or 6 years ago, or even a decade ago, I think we were trying to solve a very challenging question for our clients. And that question was, if you have stock valuations near all-time highs and bonds are yielding 1%, like all those projections that Courtney just shared depend on the return of a portfolio, especially during retirement. And so where do we get return from? And how can we manage volatility in retirement? And a lot of that for us, we've looked at the private markets, and the reason why we've added that is, number one, it's a return enhancer. We have seen that within the portfolio. I can share some numbers with you later. But also, over the past 20 years, private equity market has grown 17 times, and there's actually fewer public market stocks now than in the early 2000s. And so when you think about the opportunity set of investing just within stocks, it's way less now than it was 20, 30 years ago. So we have to explore other places within the market, aka private markets, in order to access some of those. And these aren't necessarily your Facebooks in 2005. We actually hold private, or that's not a... It's so hard to do this. This isn't like a high-flying social media tech company in 2005. These are actually, in a certain portfolio, we may or may not hold a drive-through coffee shop. So anywho, these are a number of the private investments that we currently like. And the reason we like them is a lot of them are, we have all types of flavors. So we have low leverage, income producing assets. These are great inflation hedges within portfolios. Just imagine these are a fully occupied apartment building, right? So we're basically putting our clients in position to be rent collectors. These are toll roads. These are timberland, farmland. And when you're thinking about an inflationary environment, which we are very much in right now, and if you think about some of the fallout of COVID, I think it's a good place to be, because you're thinking about reshoring and nearshoring. There's going to be investments in infrastructure. I know Courtney mentioned semiconductors earlier. With the CHIPS Act, there's going to be investment in infrastructure here in the United States. And so being a holder of some of that matured infrastructure is a good place to be right now. We also are in the private credit space. And so coming out of the global financial crisis, because of the bank regulation, banks were a lot less likely or willing to lend to smaller companies. And most of these deals are now done in the private sector. They're higher yielding than the public sector. You would have had exposure to that 20 years ago, but you don't anymore within the public sector. And last year, those types of funds did very well for us when the bond market was down 13%. And so if you kind of think back to the classic 60-40, last year was the fourth worst year ever, dating back to, I think, 1928 for a vanilla 60-40. And most of the time, that comes from the stock side. So if you think about 2008, bonds were actually up in 2008, stocks were down quite a bit. However, last year, both were down significantly. So because we had some of these diversifying assets within our portfolio, we're able to manage some of the volatility on the downside and provide cash to our clients even when the broader market was down. So right now, I'll run through this quickly, but this is kind of getting back to what I talked about earlier. So USPE-backed companies, you can see since 2000, there's been an explosion of companies in the private side. And that's just because of the maturation of a market. You know, now that there's a lot more money within the private equity space, it's a more mature industry than it was in the 90s. So they're holding all these deals now within the private space, and a lot of the growth we saw in some of the early stage companies now happens before they ever go public. There may or may not be a notable one in the payment side right now that's still private, that's very large. But and you can see on the other side, public companies, we're far below where we were in the early 2000s. I think the Wilshire 5000, which is an index, has less than 5,000 stocks in it now. So it's very, I think that's one of the stories that isn't well published, like how many good companies are in the private space right now, and I think that is on us as an investment committee to go out there and find those opportunities for our clients where appropriate in order to get that risk-adjusted return over the long term that we project on our plans. And so this is just getting to returns within the private equity and private credit space. You know, the details are over here, but essentially, if you invest in both the private equity and private or public markets at the same time, you would have done better in the private space over the last 10, 15, and 20 years. Same thing within the private credit space. So last year, as we all know, the S&P 500, the Barclays, the bond market went down, the stock market went down, international stocks went down. And what this forces is that endowment funds, large institutionalized funds, they have a mandate for how they must invest their assets. So right now, they're overweight. They have too much exposure to the private equity space. So they need to sell those assets and buy public market stocks and bonds. So in order to do that, a secondaries market is created, and they sell those at a discount in order to get back to their mandate. And so that's a space we're actively exploring right now for our portfolios, for our clients, because it's a good time. When the market started off last year, they repriced lower, and now there's 4 sellers within that market, which gives us an opportunity with some of the managers that we're looking at to exploit, I don't want to say exploit, but take advantage of that opportunity. Well,
Can I ask a question?
no, yes.
For private equity, how do you manage that with a client? Do you help them invest in that private equity, or do you have holdings that you manage on behalf of the client, or how does that work?
Yeah, I think it's a good question. So she asked like how we manage private equity portfolios for our clients. We typically will do it through a fund manager. And I'll say over the last 4 or 5 years, that space has gotten a lot more user-friendly for our clients. And from the standpoint of how you invest, it used to be very behind the black curtain. It used to take a long time to deploy capital. But now there's funds coming out where we can deploy capital a lot quicker. We can diversify across industries and what's known as vintages. Very easily within these types of vehicles. They're in vintage, if you don't know what that means, I can dive into that. It's like if you invest in 2007 versus 2009, you have vintage risk. You'd rather buy private equity in 2009 than 2007, right? And so in order to diversify across that, if I was only going to deploy like, let's say 100K into private equity, that'd be very difficult to do 5-6 years ago. Now it's a lot easier to do and manage around that position within a client portfolio. So I guess long story short, we're not going out there and isolating individual companies to buy. We're doing our due diligence at the fund level. And then, I mean, we have a lot of different flavors of that and deploying it depending on the client situation.
You don't have Northwood Tower managers?
No, not yet. But maybe in the future.
They've got a new fund that we very close to.
So this is looking back, basically comparing the 10-year forward returns right now versus where they were at in 2022. And I would say this is one of the more challenging things for us as an investment committee because the year-over-year change basically says that pretty much every asset class looks better now than it did at the beginning of last year. And so the question is, as an investment committee, how do we rank those investment opportunities, remain diversified, and take advantage of the dislocation that happened last year? And I think we kind of stay with our diversification model. Currently, we are looking more into the fixed income market because all of those reset higher last year, and that gives us a better opportunity to generate return from a kind of a safer space within the portfolio now that rates are higher. So I guess that begs the question, what about the vanilla 60-40? So the most vanilla 60-40 is 60% S&P 500, 40% in U.S. bonds. We can diversify away from that using international stocks and bonds. However, over the last 4 or 5 years, maybe 10 years, we've also seen the opportunity within the private space, because those vehicles are a lot more mature and easier to use from a client perspective, to add some of those diversifying elements. And last year, I think it really showed up in our client portfolios. You know, we actually had a fairly large REIT manager, because, you know, there's publicly traded real estate investment trusts as well. And publicly traded real estate last year was caught up, and a lot of the sentiment was down very far. And they were like, we're actually thinking about buying and taking some of those companies private, because the real estate on their balance sheet was cheaper than what they could buy in the open market. So that's why we've been adding more and more of those private investments to our kind of vanilla 60-40 portfolios. So, you want to? Question?
I don't think the public REITs didn't have a very good year last year, did they?
No, they had a bad year, yeah.
Can you explain the divergence between private equity, real estate, having a good year, and the public REITs having a bad year?
Yeah, I think it's a good question. I'm not sure if everybody heard it. He asked, why did private real estate have a good year and public real estate have a bad year? I would say our private real estate had a good year. Mileage may vary depending on what you're in. I think the major divergence is anything that's publicly traded is subject to sentiment. And so just like with the run on the banks last week, you have wild swings in valuations in any market when there's fear. Also when there's greed, like within certain meme stocks in 2021. The public markets are very susceptible to that, but private markets typically run more on fundamentals. So if you have a strong cash flowing piece of real estate or a strong cash flowing business, it's going to be a lot less susceptible to that fear and greed reflex that you see within the public markets. So I'll go ahead and hand it back to you, Courtney. Oh, sure.
Thanks, Dax. Great job. I just want to make sure everybody had a chance to grab something to eat. If you haven't, feel free. So finding your purpose. I touched a little bit about your life aspirations, but when we talk about the 5 non-financial keys to retirement success, it's what's next that happens. So we don't have time to do an entire workshop about life aspirations. What happens next with that list is that we make actionable, authentic goals, and those goals help you live your purpose every day. And so the idea is that you want to make sure when you enter retirement, just like, for example, when you go on vacation, that every day doesn't feel like a burden, right? You want to create a plan. Nobody wants to just stay on a beach in the sun and get sunburned. If you think about it in your retirement terms, you want to have an ebb and flow and a reason to get out of bed, things to do, fun things, boring things, challenges. That's what give life meaning. And so we find that the biggest thing that can trip you up in retirement is finding your purpose. So think about what you want, make sure it aligns. Number 2, protect your physical and mental health.
None of these things are going to be possible laying in a bed in poor health. So I think the absolute biggest cause of death, what do you think it is, actually?
Heart disease.
Heart disease, what? Y'all are cheaters. but that means they listen at work. So depression, the mental capabilities, you start to get depressed because you don't have purpose anymore. You're not getting up and going to work. You're not going to teach a class full of young minds. You're not going to heal the sick. You're not going to do whatever it was that got you to this point in your life. And if you've lost purpose, then maybe it becomes a mental spiral. If you actually physically have an ailment, that can also cause you to mentally start to drain. I know I've had some issues with my knee and foot, and I am not as pleasant a person when I don't get to go to the gym or go for a walk or take the dogs out. So it just becomes a spiral as you get older and more depressed unless you do something about it. So physical and mental health, that is literally, get up, go to the gym, go for a walk, take the dog for a walk, find some reason to stay active, whether it's doing crossword puzzles or something to help keep your brain going, to help, dementia is a huge issue, Alzheimer's. They're coming up with drugs every day that can help, but every little thing that you can do, I think I saw something about the Mediterranean diet now shows a really big helpful boost for pushing off dementia or whatnot. So anything you can do to keep yourself, whether it's weight or in just a good mental place, helps you over the long haul. And then people will be more willing to be around you.
Yeah, so number 3 is nurturing your friend's garden. And I'm actually going to pull up our workbook. I don't know if everybody saw that you have your workbook, but on page 46, we have Tending the Friend's Garden. And women tend to be really good at this as they enter retirement because they're involved in so many different things sometimes. And it can be easy to forge those friendships in retirement when it becomes so important as kids are far away, grandkids maybe aren't as close as we'd like. And so really fostering old friendships, but more importantly, new friendships, because as we change, the circumstances around us change, and so do we. So it's important that as we get older to align who we want around us with those changes. And so some examples in the book were serving community causes that you care about. It's a great way to meet new people, to network as you travel and go on new trips, meeting friends along the way, not to mention hobbies. For example, I just started playing tennis, and it's incredible, the community of tennis players in my area, and just watching them and seeing them thrive. I play with a woman who's 82. And she's incredible, and she's friends with everyone, and I just never would envision, and when I'm in my 80s, to have that kind of support system, that network. She plays with her grandkids and her daughter, and so it's truly an inspiration, and you could see how happy it makes her and how successful and truly a champion on the courts, but in retirement she is. Number 4.
I was going to say that 82-year-old was probably one of those that I remember when I first started playing tennis that I was like, oh, I've got this. And then those are the ones that know exactly where to place the ball and had me running all over the place and would beat me. So that, I see that. Share gratitude and experiences with friends and family. You get such a boost. They say it's better to give than receive, right? So we have a story, I think it's in the workbook, and we'll talk more about the workbook in a minute, of someone that had retired, wanted to do something, and he was approached about being on the board of, I believe it was Meals on Wheels. And he went to the meeting, and it was something very similar to what he had done in his working life, and sure, he could help with, the balance sheet and maybe some fundraising or whatever it was that they wanted him for, but he just didn't feel like that wasn't speaking to him. He wanted something that was more. He wanted to give more. He wanted to help. And so he ended up being a delivery person for Meals on Wheels. So instead of going to board meetings and writing checks, and I'm sure he did that as well, but like 3 days a week, I believe, he went and delivered meals. And just seeing the just happiness and gratitude on the people's face that he knew he was doing good helped him more than anything. And yes, he could have helped maybe raise more money, and maybe he still did that. But the good that it did in his heart to actually go out there, boots on the street, and help somebody by giving them a meal that they couldn't help themselves, did more than anything else. So find that thing that gives you the purpose that you can do to help others. And bring your kids along. Like for me right now, my boys are 11 years old, and I'm like, I need to get them out there seeing what they can do, because they have a very nice life and they need to appreciate it. And I want them to see other people and help other people, because I think over time that will be the better lesson than anything I could teach them in school. Or not that I could teach them in school, somebody could.
All right, this last one is, I think, a challenge for a lot of people. But I think I just say two things about disconnecting from the media, especially internet media, is number one, if you're not paying, you are not the customer. And so a lot of online information is driven by ad sales, which is driven by fear media. So if you are not paying, you're not the customer. The other thing that I find very helpful with this one is try to prove it wrong. So I had a friend who went down a spiral during COVID on watching videos on an online video sharing platform. Yeah, unnamed. And I would just, every time he would send me something that was a little bonkers, I would just Google, why do people believe this? Why should I believe this? And just look for counterexamples of what's going on. So those are the two things, and then also look into things like Substack or unpaid podcasts that may have information where you actually pay for it, and somebody who's very intelligent about that particular topic fleshes out some of the information and gives a lot more detail and meat to what's actually going on. Because a lot of the headlines are driven to drive eyeballs, or are there to drive eyeballs and to drive engagement, not necessarily to inform us as consumers or investors.
I think you can see that there is a lot of interconnectedness between all of these. I think one story that I've heard Dennis tell several times that just speaks to me is that he had a client who retired, had a group of guys that would meet, I believe, at Panera Bread and have breakfast once a week, every Thursday morning. And that he'd been doing this forever. It was his good pals. They had a good time. He looked forward to it. But he was having some health issues, heart issues. They were worried about him, and they couldn't figure out what it was. So his doctor sent him home and had him, I don't know, I think he was on a monitor of some variety, and I'm not medical. And when they went back and read the results, they found that every week on Thursday morning was the spike in his blood pressure and whatnot that was causing his heart problems. And so the doctor's like, what do you do on Thursday mornings? He got together with these people, and they sit and they moaned and they talked about what they saw on the news and all of the things that were bad in this world and things you see on the social media, and it was stressing this guy out. So he stopped going. I don't know if he replaced it with one-on-one time or a phone call or an email. I don't know, because you still need your friends, but you need to choose who you're around. That was causing him stress because you don't know where you're getting your information. You don't know what's real, what's not. I think I heard Wikipedia, that's, very valid. But my poor kids read something the other day, and I'm like, well, it's on Wikipedia. And I'm like, oh, no, no. So you'd never know, and it might be the last place you think you're going and having a fun time. It might not be the best for you. So he peeled back, figured that out, and I did much better with his health. So you never know what it is that is causing one thing, but that's where it's good to get a good physical and maybe find it out. You all also had a fourth quarters champion workbook. Some of you I know already have it and have looked through this. This is an interactive workbook. For those of you that have a spouse or significant other, hopefully you both get a copy of this because it gets down into the weeds on what happens as we move through the retirement years. There's a marriage quiz or a relationship quiz in here that is good because this is all about being thought-provoking, thinking about things, being proactive. If you have not retired already and you're planning or thinking about it, you need to have a plan. I'm not saying a blueprint, I'm not saying a step-by-step guide, but you need to actually put thought into it. And once you're there, keep thinking. Is what I'm doing what I want to be doing? Reassess. Reassess what you're doing if something's not working. The one thing that should not be a fear is the finances. Hopefully by working with us, Stearns Financial is the one that's worrying about your finances. If you've done a roadmap, hopefully you've done the work to figure out where you are and what you can do. If you're hitting a road bump, come back to us. A financial roadmap is not a one-and-done sort of thing. It is a living, breathing document that needs to be looked at least every 5 years or so, or if something major happens, the loss of a loved one, a divorce, the birth of a new grandchild. You never know. We've got business changes. If you want to sell a business, that's a big thing for somebody that's been a business owner and it's time to retire. That's a big shift from going boss man to watching somebody else with your baby, if you're selling it and watching somebody else run it. Might not go over so well, whether it's somebody in your family or somebody outside. So Stearns is here. We can help you with all of those parts of it so that you can worry about the things like nurturing your friend's garden and where you want to go on your next vacation and what kind of car you want to drive to get there. I will close the slideshow presentation, but Shira, Dax, and I, Teresa, are all here. Anybody that has more specific questions, private equity, go to Dax, Shira. Teresa and I are more on the planning side, so we'd love to have feedback if you enjoyed the presentation or didn't enjoy the presentation. Love to have it because we're going to do the same sort of thing in Greensboro soon, so if you missed it or know somebody that would benefit from it, please let us know. Thank you all for coming. I hope you had a lovely evening. Oh, yeah. I'm sorry.
We're going to send them a survey link tomorrow.
Oh, okay. You will be receiving a link to do a survey, so you don't have to tell us to our face how we did, okay? You can wait and do it in the cover of an email. All right? Thank you so much. And is there any questions before I close for the group? Okay. Thank you so much.
Great job.